Earnings season 2021 has kicked off. In this video, we'll get you caught up to speed with what you have to know and highlight some of the winners and losers. Through the first 2 weeks of earnings season, the clear winner has been Netflix. Investors were going crazy from the news that Netflix said that in 2021 they'll be cash flow neutral, meaning that they don't have to go to the bond markets or find external means for financing. They've achieved financial stability. Since their earnings hit the press, the Netflix stock has gone up over 13%. Over 2021, we're also likely to see Netflix repurchasing some of their stocks. Also look to see Netflix raise some of their prices across the globe. While some of their competitors like Disney and HBO Max have been struggling, Netflix is in well positioned to be the champion of the streaming sector. And not only are they going to be the champions of streaming, it looks like they're becoming the champions of media in general. Now, before we get to the losers, if you like this video, please subscribe to my channel and we'll have more videos like this. Or go down to the comment section and let me know what stocks you're looking for and what you thought of the earnings season so far. So now, let's jump over to the other side where the grass isn't as greener. And that involves two former tech giants that are on the verge of becoming possible dinosaurs in the industry. Let's first start with IBM. So IBM has reported a decline yet again, marking the fourth straight quarter revenues have declined. Also making that 8 out of 9 years they've seen a decline in revenues. What is IBM going to do to combat this? Well, they say that they're going to focus more on the cloud space. However, they've seen 10% growth in the cloud space, but that's marginal compared to what their competitors are seeing at 40 to 50% growth. Since IBM released their earnings, they've seen their stock gone down 10%. And the second potential dinosaur in the tech industry is Intel. They had actually a solid and early earnings report. Early because someone hacked an infographic regarding their earnings, so they had to hit the press early before this hack got out. Not the best look for a tech company. But overall their numbers were solid. But what investors did not like to hear was their announcement. They say that they are going to focus more on in-house production instead of looking to outsource. Their incoming CEO, Pat Gelsinger, said the majority of Intel products in 2023 will be manufactured internally. After this news, the stock of Intel dropped 9%. They're just struggling to keep up with some of the competition like Nvidia and AMD. Now looking at these two dinosaurs, if I had to purchase one of these, I would lean towards Intel. They still own a larger portion of their sector, and they trade at roughly 3 times revenue and with a PE ratio a little over 10. So in the chip sector, this is cheap. And if they focus on what they do well and get back to their core competencies, you could see a comeback. Well, IBM on the other hand, they're trying to play catch up. And they're no longer innovating like they used to for decades. I think IBM is toast. Now let's move to the sector that kicked off the earnings seasons, the traditional banks. You had JPMorgan Chase come out and announce record quarterly profits. They outperformed by $1.4 billion. And they also are looking to repurchase some of their shares in quarter one. Also, you look, Citigroup, Wells Fargo, and Bank of America all outperformed expectations. However, these banking results are not quite as good as they seem. And that's because some of these high-performing results might be inflated. And that's because the banks, and I'm talking all these banks, have built up large reserve ratios with the expectance of large foreclosures coming in the market due to the pandemic. Now, the banks set aside a lot of money thinking it was going to be really bad. And to this point, it hasn't been that bad. Now, they might not be completely out of the woods yet, but they've started releasing some of these reserves, and that's going straight to the bottom line, which is the reason why you're seeing these great results. Where, on the other hand, if you dive down into the revenues, consumer spending is still down, which means people aren't swiping their credit cards. And you also see that loans are down as well. The only thing that's been booming is the mortgage business, and that's been record numbers in 2020. But now looking towards 2021, the banking sector looks more optimistic. The banking sector will be a major benefactor of upcoming stimulus that the Biden administration has announced. And the banks have been trading down on this news, but this could be a time where you start to see things rebounding. I've been shaving a lot of my gains that I've had from my growth stocks, about 15 to 20% of my portfolio. And now I'm looking to have some of that cash that I have sitting on the sidelines might go into some more traditional stable names that have been down, but 2020 looks brighter for them. Now, shifting from the traditional banks over to the investment banks, we saw both Goldman Sachs and Morgan Stanley absolutely crush earnings. Goldman Sachs reported $12.8 billion in revenue compared to what was expected at $7.5 billion. And that was in large part because of 40% increase in equities trading. Meanwhile, Morgan Stanley reported an earnings per share of $1.81 compared to an expected $1.27. They reported strong performance in their wealth management division. Overall, this sector has been absolutely on fire since November, with both Morgan Stanley and Goldman Sachs stock rising 50% during that time period. Now, both their prices of their shares have fallen since the report, but if you're interested investing in this sector, now could be a good time because both have potential to grow over 2021. Now, moving on to a few other companies, we'll start with Proctor Gamble. There wasn't much here I liked, and there wasn't also much here that I disliked. Well, okay, their numbers were great. They reported an increase in revenue of 12% in both the US and China. And they saw balanced growth across their different product lines. But they are clearly a benefactor from the stay-at-home economy. And as things change, don't count on these numbers to continue. Next, we have United Healthcare Group. They're the first major healthcare company to report in this earnings season. And they slightly outperformed expectations, but they claim that their performance is really still struggling due to the pandemic. And finally, we'll tackle the airlines. We saw United Airlines report a $1.9 billion loss in Q4. Now, that's significant, but still dramatically improved their cash they're burning on a daily basis from Q2. They reported that they're seeing an increase of advanced bookings, and there's a large pent-up demand for travel. And the CEO went on to promise that you can see a full recovery by 2023. Delta, on the other hand, had a slight miss on where they expected revenue to be, but CEO Ed Bastian said that we expect to get back to break even by the spring. United CEO was asked about that comment, and he said, "I'm not so optimistic, I think it's the fall." But to Ed Bastian, that United is going to be number one, even though that we're projecting it to be later. So that's where we stand with the earnings seasons through the first 2 weeks. Come back in a couple weeks and we'll have more updates for you. Thank you guys for watching.